Hi everyone, Rosie here. So I've worked with IFRS in practice for many years now, and I've also marked professional accounting exams. So on this channel, what I do is break down complex accounting standards and explain the real logic behind them so they actually make sense for you in your SBR exam. So let's go. Hello, welcome back to SBR Technical Deep Dives. I'm Rosie, Fellow of FCCA and Head of Technical Accounting. And today we're covering cash flow hedges. So follows on nicely from our fair value hedges we looked at last time. So cash flow hedges are one of those topics where the accounting can look quite confusing on paper, but once you understand that logic behind it, it usually clicks. So that's exactly what we're going to do today. Okay, understanding the logic first, then the accounting will make sense. So let's go. So let's start with the risk being hedged, because that is where it all begins. So a cash flow hedge is used when business is exposed to variability in future cash flows. So not a change in the value of something it already has, but variability in cash flows that haven't yet happened. Classic example is variable rate borrowing. You borrowed money at a floating interest rate, so let's say SONIA plus a margin. Every time that rate resets, your interest payment changes. So if rates go up, you pay more. And that variability in your future cash flow payment is then the risk. Okay, so a cash flow hedge manages that risk. Another common example is a forecasted transaction. Okay, so let's say a company knows it's going to buy some raw materials in euros in 6 months' time. That exchange rate could move between now and then, likelihood it will, making the purchase more expensive, say, in sterling. That variability in the future cash flow is the risk. So in a cash flow hedge, you've got the hedged item, that variable rate borrowing or forecasted transaction, and you've got the hedging instrument. And typically that's a derivative like an interest rate swap or a forward exchange contract. They are taken out to lock in those cash flows in the future. Here's the key question though. Why does accounting for cash flow hedges look different to fair value hedges? So remember, in a fair value hedge, the risk is the change in the value of something that we already have. Both that hedged item and hedging instrument move through the P&L and offset each other. Clean, simple. But in a cash flow hedge, the risk is variability in future cash flows. The hedged item, so those future interest payments, those future purchases, haven't yet happened. There's nothing on the balance sheet to remeasure. You can't put a future transaction through the P&L now because that transaction hasn't occurred. So if you put the derivative straight through your P&L, which is what IFRS 9 normally requires, you'd have gains and losses on the derivative hitting the P&L now with nothing to offset them until that hedge cash flow actually occurs in the future. So the same mismatch problem as before, just in a different direction, really. So the solution is OCI. Yeah, other comprehensive income. It acts as that temporary holding place. So that effective portion of the gain or loss on that hedging instrument goes to OCI, which is usually a cash flow hedging reserve, and it sits there until the hedge transaction affects the P&L. And that point, when that happens, it then gets reclassified from OCI to P&L, and that's where it offsets the impact of that hedged item, that cash flow. So the timing matches, the offset works, and that's the whole logic behind it. So let's think about those entries, try and solidify it a little bit. Let's take the variable rate borrowing as an example. So the company takes out an interest rate swap. They're paying fixed, receiving variable, okay? And they want to convert it into a floating rate exposure into a fixed rate, ultimately, is what they're trying to do. So at each reporting date, the swap is remeasured to fair value. And here's where that split happens. So the effective portion, the part of the fair value movement that offsets the hedge risk, goes to OCI. Debit or credit, that derivative at fair value, with the other side sitting in that cash flow hedging reserve. You've then got the ineffective portion, which is any movement in the derivative that doesn't offset that hedge risk, and that goes straight into the P&L immediately. There's no deferral. The effectiveness is just recognised now. Then, fast forward to the future, when that hedge cash flow occurs, in this case, when the variable rate interest is paid, for example, the amount sitting in that hedging reserve is moved and reclassified from the OCI to P&L. So it offsets that interest expense recognised on that borrowing. So that net effect, the entity has effectively paid a fixed rate, which is what the hedge was designed to achieve. All right. Now, one more scenario worth knowing. So what if the hedged transaction is the acquisition of a non-financial asset, let's say? So let's say the company was hedging a forecast purchase of inventory in a foreign currency. When that inventory is recognised, IFRS 9 actually gives you a choice. You can either reclassify it to the from the hedging reserve to P&L when the inventory affects the P&L, so when it's sold, or you can adjust the initial carrying amount of the inventory for the amount in the reserve. That's called the basis adjustment. Okay, now both treatments are allowed under IFRS 9, and in the exam you'll be told exactly what to do, so you'll never have to guess. All right. Now, same as a fair value hedge, cash flow hedging accounting isn't automatic. IFRS 9 is very clear. It requires a formal designation and documentation at inception, at the start, the hedging relationship, the risk being hedged, the hedging instrument, and how effectiveness will be assessed. That's key. It all needs to be documented at the start. If it's not documented at the inception, we cannot apply hedge accounting retrospectively. It's not allowed. So the hedge must meet the effectiveness requirements. So the hedging instrument and the hedged item must be economically related. The hedge ratio must affect the actual risk management ratio, and the credit risk can't dominate the value changes. So for the exam, if the question says documentation was prepared after the reporting date or that no formal designation exists, then the answer is that hedge accounting doesn't apply. Simple, we cannot apply. The derivative goes to fair value through P&L and there's no offset. Yeah? So let's just be clear on the contrast with fair value hedges, because this does come up constantly. I see a lot when I'm mentoring. A fair value hedge, you're protecting it against the change in the fair value of something you already have. Both movements go through P&L and offset each other in there. Nothing goes to OCI. Flip side, cash flow hedge, what you're doing is protecting against variability in future cash flows. So the effective portion of the hedging instrument goes to OCI first, and then we reclassify to P&L when that hedge cash flow occurs. The timing match is the whole point there, okay? They're different risks, it's different accounting, but it's the same underlying logic, and ultimately what we're trying to do is prevent artificial volatility in the P&L that doesn't reflect the economic reality of what is happening, okay? So let's pull it all together. Cash flow hedge protects against variability in future cash flows, so variable interest rate, forecast transactions, foreign currency purchases, whatever they might be. Effective portion of that hedging instrument goes to OCI and sits in the cash flow hedging reserve until that hedge transaction hits the P&L. Ineffective portion goes to P&L immediately. All right. Remember, formal documentation at inception is required. No documentation, no hedge accounting. That's what we've got to remember. Logic is always the same. We want to match the timing of the hedge gain or loss to the timing of the hedge item's impact on the P&L. That is what we're trying to achieve. And once you see it that way, the accounting stops feeling a bit confusing. It starts to make a bit more sense. Okay. Hopefully that was helpful. Next time back with another deep dive. See you soon.